September 2000. Reed Hastings and a small team from a cash-burning startup traveled to Dallas, Texas to secure a meeting at the corporate headquarters of the undisputed king of home entertainment, Blockbuster. The startup team makes a desperate pitch. They offer to sell their entire company to Blockbuster for $50 million. In exchange, they propose managing Blockbuster's digital presence and mail-order operations, combining massive physical retail with a growing online network. According to the startup founders in the room, Blockbuster's executives found the proposal genuinely amusing. CEO John Antioco visibly struggled to suppress a laugh, dismissing the dot-com hysteria as overblown and the online business model as entirely unsustainable. The Netflix team left the meeting empty-handed. 10 years later, the corporate landscape violently inverted. Netflix skyrocketed to a multi-billion-dollar valuation, establishing a global subscriber base. Blockbuster, meanwhile, faced complete financial ruin. Blockbuster's rejection is widely remembered as an act of immense corporate ignorance. Yet a closer look at their internal numbers reveals something much more dangerous. Their leadership made a perfectly rational economic decision, one that proved entirely fatal. In the year 2000, Blockbuster operated nearly 9,000 stores worldwide, serving 60 million regular customers. Their dominance was built on immense physical inventory and the friction of in-person retail. But their massive profitability relied on a controversial, highly specific financial mechanism. Customers were charged roughly $1 per day for any movie returned after the rental window. This visualization breaks down Blockbuster's total annual revenue at the time. Notice this isolated 16% section. That represents $800 million generated entirely from late fee penalties. It was a massive, highly predictable stream of pure profit. The entire corporate structure optimized around this single metric. Budgeting for store leases, planning inventory purchases, and tracking employee hours were all built on the assumption that customers would inevitably pay for returning tapes late. Blockbuster had successfully engineered a financial engine that depended on generating friction and resentment among its own user base. When Reed Hastings arrived in Dallas, the macroeconomy was heavily biased against him. The dot-com bubble was in the middle of a historic collapse. Investors who had poured money into unproven internet companies were actively losing billions. Netflix was bleeding cash. They had barely 300,000 subscribers, and their product relied entirely on the speed of the U.S. Postal Service, meaning customers had to wait several days to watch a single movie. Blockbuster, conversely, was a publicly traded juggernaut. Their executive team was legally and financially obligated to deliver steady 90-day earnings growth to their shareholders. Spending $50 million to absorb an unprofitable startup with massive logistical hurdles would immediately hit Blockbuster's balance sheet as an expense. It would drag down quarterly earnings, anger institutional investors, and depress the stock price. Rejecting Netflix protected immediate shareholder value. By the strict metrics of public markets in the year 2000, passing on the acquisition was the correct decision. Business theorist Clayton Christensen identified this exact corporate paralysis in his research on the innovator's dilemma. Look at this growth comparison. The flat line represents an incumbent company's steady, highly profitable operation. The rising curve represents a startup gaining momentum. Doing everything perfectly makes the incumbent vulnerable. To adopt Netflix's model, Blockbuster would have to intentionally detonate their $800 million profit engine. Netflix had absolute freedom. Because they were unprofitable and privately held, they had zero physical stores to protect and no legacy revenue to cannibalize. Blockbuster's massive retail success created a rigid financial structure that actively punished them for innovating. In the short term, Blockbuster's decision paid off. By 2004, the company reached peak earnings of $5 billion. Physical retail remained the global standard for video distribution, but Netflix used the next few years to refine their logistics and accumulate digital licensing rights. In 2007, they launched instant internet streaming, a massive technological leap that required a vast server infrastructure Blockbuster did not possess. Blockbuster attempted to respond with Total Access, an online initiative that was disastrously tied to physical store memberships. It was complex, expensive to maintain, and entirely missed the simplicity of digital-first delivery. The collapse was rapid. By 2010, Blockbuster stock dropped 91%. In 2011, they filed for bankruptcy, burdened with $1 billion in debt. Their 9,000 physical locations transitioned from an unassailable competitive advantage into worthless real estate liabilities in less than a decade. The executives in that Dallas boardroom did exactly what they were hired to do. They defended their margins, protected their shareholders, and maximized their existing assets. But the true threat wasn't even in the room. Broadband streaming, the technology that would actually destroy physical rental, was largely theoretical in the year 2000. By the time streaming matured enough to appear on Blockbuster's balance sheets in 2007, the engineering and cultural gap between the two companies was insurmountable. Netflix had spent a decade building the future. Blockbuster had spent a decade maintaining the past. Optimizing perfectly for the present guarantees blindness to the future. In the mechanics of corporate survival, peak success is often the ultimate blindfold.